All right, we got a great team to take us into the bell here. Joining me, Liz Ann Sonders, Chief Investment Strategist at Charles Schwab, Michelle Gibley, Director of International Research. Great to see you, ladies. Good afternoon. Kind of somewhat of the calm before the storm, but it's not that calm out there, Liz Ann. We are chopping around. It seems like there's some nerves still here ahead of CPI tomorrow.
I think there are. It was kind of a funky day, in the immediate aftermath of what looked like a benign PPI print. You did see a retreat in yields, and the equity market turned around, but it's been waffling up and down a little bit since then. I think that may be because one of the components of PPI being airline fares, that does go directly into PCE, which of course is the Fed's preferred measure. So I think that may have provided a little bit of angst, and now we'll have to see with CPI, although we've seen yields retreat again a little bit, and the dollar continues to move slightly lower. So, I don't know. I think CPI could be a market moving event, but it also could be benign like PPI was.
Okay. Kathy, where do you think, or rather Michelle, sorry, where do you think the international market kind of sits in watching the U.S. at this point, given that our bonds and our dollar have been really the story of the last couple months? What kind of ripple effects would it have if CPI comes in warm tomorrow?
Well, I think that we're seeing currency market volatility and volatility in government bond yields globally. Partially related to monetary policy, but it's also, looking more and more, it seems like, at trade policy and fiscal policy. If you look at government bond yields, they're rising globally. It's not just in the U.S. And, fiscal deficits remain high, inflation is stubborn, and there's a lot of uncertainty about, U.S. tariffs on imported goods. So we'll see how that all plays out.
I guess from the international standpoint, probably the tariff stuff is more of the crucial calendar item. Is that fair, Michelle?
Yeah, last night we got a report of a gradual increase in tariffs. It's eerily similar to May of 2019 when Trump announced a 5% tariff on Mexican imports into the U.S. To take place in 10 days, escalate by 5% a month, reach 25% in 5 months, but it never actually happened because Mexico agreed to measures to stem the tide of migration. And so there's, little uncertainty here as we go into next week. Is Trump going to come in big and then negotiate down, or is he going to come in low and then negotiate up? But I think overall, these tariffs might quickly come and go. But for investors, it might be better to take a long-term view rather than trying to trade every announcement.
Fair enough. Liz Ann, thinking about the next couple of weeks here and what does really matter, obviously we've got inflation and economic data that seem to have been moving the markets, but I do kind of wonder how much of the causality of market movements the last few weeks have also just been kind of blurred with policy speculation kind of dying off a little bit, or just uncertainty now that we're actually kind of arriving to the point where you had this big move after the election on all these ideas, and now we got to see which ones actually come true.
Yeah, not only that, you continue to see a pretty wide chasm between soft and hard economic data, soft data being survey data. We got the NFIB survey, which has a lot of questions, a lot of answers, and it does show that optimism has picked up. But embedded even within metrics like that is ongoing uncertainty. I think we may now have a little bit of a reprieve, at least for the next week or two, until we start to see what the executive orders are, because we're now heading into earnings season. I think, earnings season is always important. It's the fundamental we can track. It's the denominator in the valuation equation. But I think particularly important is the outlook this time, because we have seen a retreat in estimates since early October, which of course was just in the lead into third quarter reporting season. And since then, we've seen a pretty significant haircut to fourth quarter estimates. In early October, fourth quarter estimates were close to 13%. It's now 9% and change. And a little bit of a haircut has occurred over that same period of time to the tune of about 1 percentage point in calendar year 2025 numbers. And 2025 estimates are predicated on record-breaking profit margins. So leaving aside government policy uncertainty, I think the outlook portion of earnings season is really important this cycle.
Okay, so the expectation that margins are going to have a huge or hold a huge expansion is a pretty high ask, it seems like.
We'll see. I mean, profit margins have maintained at a pretty healthy pace, but at some point there probably has to be a give, especially if there continues to be inflation and that pricing pressure, and maybe less ability to pass on those higher costs. And you have to bring tariffs into the mix, of course, on that as well.
Okay. We got a lot to balance here, but at least we've got 1 week without a lot of other central bank stuff. I guess next week we'll talk Bank of Japan, Michelle.
Yeah, the Bank of Japan, they'll be the first central bank actually to react to a new Trump administration. It's interesting. Last night, the deputy governor there said they're specifically going to be listening to Trump's inauguration address for broad direction of policies from the new administration. And policymakers there have been hinting recently that they may be hiking rates next week. We don't have as many people short the yen, nowhere near the extreme short positions of July. But the Bank of Japan has tended to surprise markets in the past, so it's something to keep an eye on.
All right, good stuff. Appreciate it, guys. Thank you very much, Liz Ann Sonders, Michelle Gibley.